Pattern recognition or pattern hallucination. The divergence trap on multi-timeframes uses at the worst possible moments, because your brain is built to find signal in noise and then protect that signal as if it were your child. When a stock grinds lower but RSI prints a higher low, you don't just see lines, you see a narrative. Energy is waning, sellers are exhausted, mean reversion is loading. Confirmation bias takes the wheel. You scroll Twitter and find a chart that matches your thesis, and your mirror neurons fire. You internalize someone else's conviction as your own. Cortisol rises with every tick against you, narrowing your attentional spotlight until you literally stop seeing the data that doesn't fit. The more timeframes you overlay, the more agreement you can manufacture. On the 1 minute, it's a bullish divergence. On the 3 minute, it's constructive. On the 5 minute, coiling. On the 15 minute, a classic lower high into resistance that your mind demotes to background noise. You aren't trading the auction. You're negotiating with your beliefs. Divergences work until they don't. And they don't in exactly the moments your emotions are most invested. The paradox is brutal. The perfect multi-timeframe alignment tends to appear at crowded inflection points where stops cluster. Perfect setups fail most often because perfect is also obvious. When the whole room leans into a clean signal, the first flush through that level harvest stops, prints a fresh low, and only then does the bounce appear. Without you, because you're flat, stunned, and vowing never to trade divergences again. Or worse, you widen the stop, remove it just this once, and convert a paper cut into a drawdown that invades tomorrow's trades. Mark Douglas called it out. Markets deliver a random distribution of wins and losses over any given series, even if your edge is real. Probability thinking isn't a slogan, it's a nervous system you build. If this divergence must work lives in your head, you are not thinking in probabilities, you are clinging to certainty. That belief clash is the root of the stop-loss removal syndrome. Inside your chest, red P&L doesn't feel like numbers, it feels like self-threat. Your amygdala pairs the red with pain, and serotonin depletion after losses amplifies the need to get back to even, which is why revenge trading often follows a textbook divergence that failed by 3 ticks. More analysis often equals worse results because the extra timeframes become a mood regulation tool, not a decision tool. You aren't adding context, you're adding comfort. The costly pattern usually starts the same way. You chase agreement. A clean RSI divergence on the 1 minute looks even better when mass CD crosses on the 3 minute, and the 5 minute prints a tiny hammer at prior day's low. You upgrade risk because everything lines up, but your position sizing is responding to perceived certainty, not actual expectancy. You anchor the stop just below the wick because everyone else will, so everyone else does. The first drive pulls the tape into your level, the bid vanishes, your stop prints with slippage as a sweep runs the pool. The bounce happens seconds later, but you're out, or you've removed the stop to avoid the pain, and now you're stuck in a slow bleed. The exit greed extension kicks in when the second divergence works, but you refuse to scale because you need to make back what the first one took. You hold for the true mean reversion, watch price stall at VWAP, and then flip your P&L from green to red on the next impulse. 2 trades, 1 unconscious loop, hesitation at entry, rigidity at stop, greed at exit. Layer on a second trap, chart pattern hallucination. In quiet tape, your pattern detection hardware becomes a projector. You see a hidden divergence on the 2 minute that exists only because you drew the anchor points creatively. You latch onto a micro double bottom that would be any other shape if shifted by 2 candles. Meanwhile, order flow shows heavy offers, refreshing at a level you labelled support. If you ignore level 2 and the footprint, divergence becomes a story you tell yourself about momentum, not a measured edge. That story, blended with adrenaline during volatility, locks you into overtrading 15 tiny attempts to catch the turn when the day is trending and the auction isn't done. The tighter your stops, the bigger your losses, because you're placing them where the auction naturally searches for liquidity. More screens, less clarity. Marcus trades this exact battlefield every day. He's an Algo-Hybrid half discretion, half machine with TradingView charts on his left vertical monitor, a DOM and footprint tape in the center, and a small window running a custom divergence scanner he coded in Python. He holds positions minutes to hours, but never overnight. His mantra: emotions are data points. He knows divergences can work, but only inside the right regime and with the right risk map. At 8:20 a.m., he runs a pre-market process that would make a surgeon jealous. He tags the day's auction context. Trend day candidate or balanced? Volatility regime? News landmines? He plots overnight high-low prior day's value area and the location of obvious stop pools. Then he asks a Douglas-style question. If he truly thought in probabilities, where would he be wrong fast? During the open, Marcus doesn't click because a pattern is there. He requires alignment between the divergence and actual auction behaviour. That means a 1-minute bullish RSI divergence is noise, unless the 5-minute shows either absorption on the footprint, buyers hitting offers without moving price lower, or an imbalance shift, delta divergence that confirms buyers gaining. He doesn't average down because his system labels that belief defense, not strategy. He also tracks his biochemistry. After 3 red positions in a row, he knows his cortisol stays elevated for 30 minutes. His rule? Walkaway timer. He literally leaves the desk, does box breathing, and returns when his HRV says he's back to baseline. More calm, more clarity. He accepts that most traders lose money because they treat risk like a negotiable opinion. For him, risk is the definition of the trade. If a divergence entry requires a stop under the low, he sizes the position so a clean stop out costs 0.5R, not 2R, because he knows it will bounce. He has made all the mistakes. Stop loss removal. He paid in scars. Revenge trading loop. He once turned a good morning into a week-long drawdown because the third divergence had to be the one. But Marcus learned to reframe the paradox. The best divergence trades feel uncomfortable. When the tape is red and the indicator whispers green, his nervous system insists he's early. That discomfort is not a veto. It's a weather report. He's not trying to feel certain. He's trying to stay probabilistic. He quotes Schwager's prose to himself. The market owes you nothing, and discipline is a position. He respects that pattern recognition is earned. Steenbarger's deliberate practice, while pattern hallucination is rented dopamine. He makes his platform boring on purpose. Grey background, minimal indicators, no social feed during active sessions. Fewer stimuli, fewer hallucinations. Rewiring your trading around the divergence trap starts before the market opens. First, build a regime filter. Divergences mean revert best inside balanced rotational sessions, not trend days. Tag that with a simple mechanical checklist. Is average true range rising? Is the opening drive extended beyond overnight extremes with expanding volume? Are breadth and correlations one-sided? If 2 out of 3 say trend candidate, you downgrade every mean reversion setup by half a grade. Second, define a divergence as a setup, not an edge. Your edge is the confluence of A, divergence, B, location at a true auction level, prior value edge, volume node, liquidity pool, and C, order flow confirmation, absorption, chart imbalance shift. No order flow, no trade. Third, change how you place stops. If your stop sits exactly under the obvious wick, you are advertising your liquidity. Use structure-based stops, under the low plus an average sweep distance, or use a time stop. If buyers don't reclaim VWAP in 3 minutes after the divergence, exit. Tight stops are not professional. Appropriate stops are. Fourth, fix sizing. Position sizing is where belief meets the balance sheet. Decide R first. If your plan risks 0.5R per attempt, you can make 3 attempts at the level and still be down 1.5R, manageable for your psychology. Fifth, adopt a 2-gate entry. Gate 1, technical signal, divergence at location. Gate 2, market behaviour. Order flow confirms. Only if both gates open do you click. Sixth, install a walkaway timer for tilt. After a stop out that triggers an adrenaline spike, step away for 5 minutes. Let chemistry pass. Don't let chemistry place your next order. Seventh, journal the difference between recognition and hallucination. After the session, paste screenshots of every divergence you took and 2 you didn't. Tag, regime, location, order flow. Outcome, emotion at entry. Note especially the ones you saw that weren't there when measured. You'll shock yourself. You will also train your pattern recognition like a muscle with deliberate reps. Eighth, pre-commit exits. If price reclaims VWAP and prints a momentum candle into a known liquidity shelf, scale a third. If delta flips and fails to progress for 3 minutes, scale another third. Put the sell orders into the book. You don't rise to your intentions, you fall to your execution. Ninth, design a hold map to fight premature exits. The dopamine hit from green P&L is a trick. Your brain tries to lock the gain to relieve tension. You counter that with a map. Once in profit, trailing stop follows the last swing, low high on your entry time frame, not your feelings. 10th, turn your platform into a feedback lab. Add a mild alarm when you place more than 3 trades in 10 minutes and overtrading Sentinel. Add a risk-used widget that shows percentage of daily max loss consumed. When it hits 60%, your platform should pop a full-screen reminder. Risk management is survival. Finally, embrace the paradoxes. The best trades feel uncomfortable because they're bought into fear and sold into relief. More screens often equal less clarity because your mind collects comfort, not data. Tighter stops mean bigger losses if you park them where liquidity hunts. More analysis can mean worse results when you use charts to regulate anxiety instead of measure auction behavior. When you accept those paradoxes, you stop arguing with them and your execution steadies. Picture the next morning. You load your TradingView chart, sip coffee, and label the pre-market like a cartographer. Overnight range is narrow. Volume profile shows a fat node just below the prior, closer magnet in balanced conditions. Breadth is mixed. You tag rotation likely. During the open, price flushes into that node. RSI prints a higher low on the 1 minute, while the footprint shows a wall of market sells, and price not budging. Absorption. Gate 1 opens, you wait. Gate 2 opens as delta flips positive and price reclaims the level. Entry, small risk, your stop. Not under the obvious wick under the structure, plus a sweep allowance. 2 minutes later, it's at VWAP. Your map scales a third. It pulls back, holds the reclaimed level, and surges. You trail by swing. No drama on the tape, no emergency in your chest. When a news spike hits and the candle rips through a pocket, you don't widen the stop to protect an opinion you fell in love with. The line prints. You exit per plan. The market continues, sometimes with you, sometimes without you. You shrug, document, move on. The transformation isn't that you fixed your emotions. It's that you stopped asking your emotions to predict markets. You redefine divergence as a setup that requires context, not a guarantee that demands loyalty. You learned probability thinking the hard way, by scripting risk before scripting reward. You turned pattern recognition from a serotonin lottery into a measured, reviewable process. You built a pre-market routine that shrinks overtrading, a position sizing rule that immunizes you against one more try, and an exit map that protects you from your own dopamine. You started treating your mind like part of the platform, configurable, testable, upgradable. You'll still miss trades. You'll still take clean stop-outs that reverse in your face. And sometimes the big divergence you passed because the regime screamed trend day will knife higher without you. Good. That means you're in the right game now. You don't need to catch every move. You need to execute your playbook. Most traders lose money because they confuse conviction with edge. You won't. You'll show up, label the auction, require gates 1 and 2, risk 0.5R, and let the market pay you when the auction agrees. And when it doesn't, you'll close the position, breathe, and log the rep. The lures remain the same green P&L, comfort, certainty. But they've lost their teeth. The multi-timeframe divergence is still a beautiful pattern. It's just not your savior. It's a setup inside an auction that doesn't know your name. Not financial advice. Past patterns don't guarantee future outcomes. Risk management is survival. Trade small enough that losing doesn't change how you trade. Then treat every divergence like a weather pattern. Sometimes it brings rain, sometimes it's just wind. Your job is not to control the sky. Your job is to carry an umbrella and keep walking.